Good evening, everyone. Welcome to day 2 of our bootcamp. I see Joe is also here. Good evening, Joe. Can you hear me?
Yeah, good evening, Julie.
All right, nice. So today is going to be clean. Since you can hear me, you know how we did it yesterday.
Yes,
Once, let's say, we're not planning to have a glitch, but if we do, please, once I'm online, just let me know. You confirm that you can hear me, then I'll proceed with the section, okay?
yes.
All right, so Elie, can you please officially check if you can unmute the microphone so I know you're also
Yeah.
good. Then I'll proceed with
Does
sharing.
everyone hear me clearly?
Yeah, I hear you from my end.
Okay, good.
All right, so
Okay. Yeah.
welcome everyone. I think everything is good to go. On the day 2 of today's of the bootcamp, today we're going to be handling stocks trading. Okay, so our guest, Elie here, is very familiar with. Let me check something.
So you know what? Maybe I'll try to introduce myself as best as possible because it sounds like my sound might be better, my connection. And um and without the more of an introduction, we'll still make do. We'll still be okay.
So while you go through this file, as Elie give us a breakdown of his own insights from his experience, I want you guys to also go through the insights on how you make money, the history of stocks trading, and all those, little details that was put together in the research. All right, so that is within the file. And Elie, you can now, proceed since my network is not that
Yeah.
good. So we can have something.
Okay. So I'll start by going through the file quickly, reading through the it's about 1.5 pages, and I'll elaborate on some points that will help explain to us about the stock market and what's valuable to know. And along the way, if anyone has questions, just because I may not be looking at the chat at the time that I'm speaking, so please just unmute yourself and interrupt me to ask any questions you have.
Okay, got it.
Okay.
Before you go on, King Solomon, if you can hear me, I think I got disconnected as an admin, so I don't really have rights to control anything, so I can mute the background noise while he's going on. And before he goes, please, this is the official day 2. I think we should still go formally with the introduction of yourself. I think everybody's still in the background understanding of,
That makes sense.
the guy who is talking
Yeah.
in the background. Let's just, go through. And I know you always like to highlight the fact that you're a Jew. So I don't know if you like to give everyone a little insight to yourself before you proceed with the class. Okay.
Yeah, by all means, yeah. So my
All right.
background is I'm from America. I grew up in America. I grew up in New York and within the Jewish community over there. And I would say that with that background, so a lot comes with it from many different angles. Whether it's cultural, whether it's social, whether it's financial, whether it's the way we see things, the way we interact with people. So there are a lot of things that may come into play. I find that a lot of in the culture itself, people are what? So I find that in the culture, a lot of us are into investment more than trading. I think culturally we're more into investing, we're into business, we're into these types of things. And we're not as a culture, we're not I would say we're more into the Wall Street part of trading, but not so much like a guy at home trading Forex for whatever reason. But I think that's an American thing that Americans don't trade Forex very much. And that has to do with regulations and what's accessible and available to us. And because the Forex market is basically unregulated, it's unstandardized. So any price that you see on a currency is issued by that specific broker as opposed to one unified system. And so America basically clamps down on that type of stuff to prevent a lot of, I would say, foul play, similar to CFDs, where CFDs represent something that you would trade in the actual stock market or futures market. So instead of buying or selling, let's say, a share of a Google stock, that goes through the organizational bodies in the stock market, in America. So what you have mostly accessible to you, I think in Nigeria, if you don't have a share of a stock itself, so you have what's called the CFD, which basically is the broker saying, we'll give you access to buy something that represents the share of Google. So the price of that thing that you're buying and selling is determined by the broker and the buyers and sellers through the broker. So it's kind of like a backdoor way of buying something. You're really buying something that represents something else, which maybe call it a derivative. A derivative is something that gets the value not because you're purchasing the thing itself, but it represents the value of something else. So the pricing is determined by the broker itself, and therefore there's less regulation. And so that's not, America doesn't even give us access to that. So, okay, that's briefly in terms of trading. And so in the stock market itself, I've been putting money into the stock market. I would say since maybe around high school time, maybe since I was around 13. I got what's called, for my bar mitzvah, you get a little money for gifts. So I put that into the stock market. And unfortunately, it's still in there. Someone else has it now. He probably bought himself a nice car or something. And I would say, I became consistently profitable. After all these years, I became consistently profitable about a year and a half ago. And now my trading is, I would say, quite consistent.
I just had to just say something because this is fantastic. First of all, I think everyone is getting a bit of insight to, the experience of what we're going to be looking into today. I just had to come in so everybody is not lost in the entire class before we actually, start it. So sorry about the interruption. But first of all, for those of you who maybe you might not, you're not really familiar with a background understanding of how, the regulated bodies work. Let me put it this way. Let's say, for those of us who look forex trading like something we, find online, get your app, fund your account, trade, you don't really see the connection between the banks. You don't really see the connections of maybe a simulation and the financial body, like how you have your technical analysis. You don't really look at the politics. You don't really look at news. Let's say you don't really send those kind of stuff. You don't really look at bank stuff. What we're trying to do here is that we're trying to show you that there's a lot of understanding, basically the fundamental structure of what you're doing, trying to make money from the financial market through Forex or stock or crypto, is still interconnected with the whole system that is happening on the banking space, on the political space, on the educational space. Everything is all connected, basically. That's why you're investing your money in. So forex trading is not a scam, first of all. It's not a Ponzi scheme. It's not what you think that is something that can give you a lifestyle where you see guys showing cars and all of those stuff online. It's not that. basically he's telling you that he's profitable. He just got profitable a year and a half ago. And then he's now consistent. We had the other brother yesterday give us an insight to how he trades like a hobby. I think that was great. He gave us insight to how trading is a hobby to him. Being profitable is basically just waking up, placing a trade and making money that day. That's profitable. You lose the other day, you lose, you make some money. But at the end of the day, if you put your accounting together at the end of the month, you made money. And there are certain things you can point out that you basically did with Forex trading. Was it farming? Was it investing? Maybe you took some, profit account and you were able to get paid. What did you now use the money for? So forex trading is not supposed to fund you constantly, like thinking that's a job, like that's what you wake up every day and do. It can be a system that can raise up capital for you if you're smart enough or if you're disciplined enough to follow up with the system. So you have to think long run. And at the same time, when you get insight from forex trading, like as to an advanced system, like we just said, there are certain, things that could represent things, but they're not really what they seem. So basically, we're talking about symbolism here, which is kind of like what I did in the video on YouTube. On the video, I talked about symbolism. I'm trying to give everybody an insight because basically this stuff are symbolic. Okay. So when you're looking at that aspect and you're thinking, okay, maybe you want to go into the craft of the digital space, like what I'm doing right now, because I can promise you by the time we are done with this boot camp and you look into the video of the content of what we're going to make with the recording, inshallah, I like to say that too. When you look into the video of that, you're going to be very, very amazed at what you're being a part of. You understand? And at the same time, we're going to be making this content go to a level where even in the next 10 years, people are going to be looking forward to this as a means of getting an insight into how to trade the stock market, getting an insight into how to trade the forex market, getting an insight into smart money concepts, psychology. Tomorrow's topic is going to be on psychology with King Solomon. So we're looking forward to that. Then we're going to have classes on smart money concepts and all of those stuff. Yesterday, I gave you guys a breakdown of forex trading from a fundamental level. Okay, so I gave you guys insight to the history, what happened, how we got from gold to flat currency. Now, sorry, I want to give you guys this basic breakdown before he goes into today's class, because I don't want to interrupt me again. Okay, so just listen and maybe go through the slide while I go through this breakdown, and then when I hand the floor over to Elie properly, we can now know that we are into stocks trading. Okay. Okay. Now,
it's a good introduction and good information. Thank you.
okay. No, by me, I just had to. I think
Yeah,
today's
no,
section
it's
is
valuable.
going to be fun.
Yeah.
All right. So yesterday I gave you guys insight on a fundamental level of forex trading. So when you're saying you're a forex trader now, you can say, okay, forex trading is a simulation. Yes, it's related to betting. Yes, but it's also psychology. It's also tactics. It's also symbolic. It's also having insight to what you can do with technical and what you can do with fundamental analysis. And basically, it comes from a foundation where you can also trust as logical as possible. That is saying the gold standard being dissolved and coming into flat currency, and what I explained to you guys about that. So when we're talking about that, that's where forex trading comes from. So you're not doing something that just popped up on your ad that says go and trade forex, go and invest, go and do that. That's not what you're doing. You're basically trying to join a system of politicians and a system of economists, accountants, and basically just do it as a hobby. You're just about to do something that serious as a hobby. That's what forex trading is all about. Okay. So when we have that fundamental understanding, for those of you who are very new, you can now go and look into the MetaTrader 4. That's an app, you use for forex trading, the MetaTrader 4. For those of you who already know this, now look into the app like a tool. Don't look into it as just an app where you go to Facebook and look into things, or an app where you just go to trade.
He'll come in. What I want to do with my introduction and what I want to communicate about the stock market and my experience and my perspective is to explain my system, which I have found is effective for me, that it basically guarantees profitability. And the system is very applicable to the stock market. And it's a lot of it is very applicable to every market. What I am able to say in my discussion is that I'm going to say certain categories, which of course you'll have to fill in the blank yourself. For example, I can't tell you all the little information that you're going to make a decision based on, because my mind, my eyes, my brain thinks a certain way and will see certain things, and I know certain facts or information, and you may know others, or you may think something else, or you may see things differently. So, for example, the chart patterns, or the what I see on a chart may be, like I'm going to say a little later, that I use the Wyckoff method and SMC, ICT, and algo structure, these things. So I would say that for me to use these methodologies is very effective for me. But of course, that's based on what I know of those methods. If you only know the terms, but you've never learned some of the technical details of them, or you are not confident in your decisions when you look at Wyckoff structure. Is this proper Wyckoff? Is it good enough? How close is it? How bad is it? Is it good enough to take a trade? Is it good enough to put in a full position size? Or should I only put in a little bit? Let's say normally in my positions, I put in, I'm going to use for my examples, I'll use a standard position of $100 because it's easy for the math to break it down. So if, let's say, normally I put in $100 to each position when I put my full position in. So if, let's say, I'm only a little bit confident, but it's more than 50-50, so then maybe I'll only put in, let's say, $50 or $20, because I don't like being in positions where I'm not really, let's say, more than whatever percent you can put, let's say 80% confidence that this is good structure and I'm managing the risk correctly, managing positions correctly. Okay. So, but a lot of what I'm going to say is applicable to every system of trading, whether it's stocks, whether it's futures, whether it's currencies, and you'll be able to apply it in different ways. And if the truth is, because I do have some experience trading Forex, I do trade options, I do trade futures. So you can always feel free to follow up with me now and ask questions, or after this boot camp session, and feel free to what? So you can feel free to ask me personally. I'm not right now in my life, I'm not doing mentorships or anything, so I'm not charging anyone. I'm not doing that, but I'm more than happy to answer questions, show you my portfolio, show you the positions I'm in. If you want recommendations, I could tell you the way I think of things or what I would recommend. By all means. So now we'll start with the well, I would like to say that when I started to become consistently profitable, it was about a year and a half ago. And it was after being in Jay's chat, in the Telegram chat. I was searching for some trading chat. I just got the app and I'm like, let's see if I could find anything good or valuable. And I saw mostly in the chat, it was just chart after chart after chart after chart, and the drawings and everything. So I'm like, okay, not a lot of talking, just learning. Just give me a chart, give me a chart, give me a chart. And you gain what we call muscle memory. You gain enough experience of just seeing one chart after the other that you eventually start to see things in common. You start to see what your chart may not have when you're looking at a potential position, a potential trade. And then you say, hey, the last 150 charts that I just saw yesterday all had something that the chart that I'm looking at does not have. So you start learning things. And over time, over the last year and a half, I was tweaking and tweaking and adjusting and adjusting and adjusting my approach and my strategy and little things that I found are very effective for me. It doesn't mean that they'll necessarily be effective for someone else because you may not execute them the same way that I do. However, for me, the system works. And like I've discussed with Jay in the past, that every person's natural perspectives and methodologies and strategies, whether you're using SMC or Wyckoff or VSA, volume spread analysis, or ICT, or trend lines, or indicators, or any of that, you're looking at the price of some currency or some
Sorry,
stock.
please. Sorry about that. Sorry about the interruption.
Yeah.
King Solomon, please, if I got logged out again, can you make me an admin so I'll focus on muting guys and when their microphone go on mute, then he can continue. So sorry about the interruption.
Yeah. Okay. So everything that you'll see in the market, and this is, I think, very valuable, especially if you're a beginner, if you're intermediate, if you're still not very confident in your own method, that when you see a chart, you're able easily to disregard everyone else's opinion and everyone else's perspective, and you just look at the chart or whatever it is you look at, and you say buy or sell, and you come up with the answer by yourself without considering, oh, but that guy, since Jay or this guy or this guy or this guy is such an expert, so it plays with your own opinion. So if you're still at that stage where it's messing you up, so it's valuable to understand that when you look at a stock or you look at anything else and you see an indicator, whether it's RSI or MACD, it's telling you something about the chart. And when you look at a trend line, it's telling you something about the chart. When you look at support or resistance or a market structure shift, a break of structure, a change of character, it's telling you something about the underlying chart. So it's not telling you to buy or to sell or stay out or to stay and hold. It's not telling you to do anything. It's just indicating something. So it's the all these things are valid, but they're all facilitating your perspective on what you're looking at as the underlying investment vehicle, I'll call it. So never think that one thing is correct or incorrect, unless you're looking at it incorrectly. But there's no such thing as correct or incorrect. So, okay, so that's part of the way that I think about the market. And now let's get into first Jay's pamphlet that he sent out. And then I'm going to go through my system of trading. And I'm going to share the notes that I put together on that in the chat once we're through with Jay's booklet. So we'll start here. Beginner's Guide to the Stock Market. The stock market is like a big marketplace for buying and selling pieces of companies. When a company needs money, it goes public, as it's called, by selling shares. Each share or stock is a small part of that company. Owning a share means you own a tiny piece of the company. What that means is if, let's say, you have a company and you say, I sell fruits on the street. And let's say I sell $1 of fruit a day. So let's say there are $100 days to the year. So in a full year, I'm going to make $100. Okay, 5 years, I'm going to make $500. So if we were to think of it that way, assuming that the fruits to you are free, you didn't pay for the fruits. So whatever you sell, that's your profit. So that means your business brings in $100 of profit a year. So if let's say you want to say to someone else, I sell $100 of fruit a year, but I want to buy another cart, and the cart costs $100 or $50. And um, so what I want to do is, in order to raise money to buy the cart, is I'm going to sell a part of my ownership in the business. So I'm going to go to Jay. So me, Elie, I own this fruit stand. I make $100 a year. I'm going to go to Jay. I'm going to say, listen, my business makes $100 of profit every year. I'm going to sell you half of my business. So you and I, we're going to split $50 of profit. But in exchange, you're going to give me $50 today. So that's how I'm raising $50 that I can then buy another cart. Hopefully, when I purchase that new cart, I'll be able to double the income. And Jay's $50 will become 100. My $50 that I was left with will become 100. And now the business is bringing in $200 a year. So conceptually, your right now, I would say that there are 2 shares of the business available. I own 1 share. It's 50% of the business, and it's worth $50. And Jay owns 50% of the business, and that's the second share, and that's also worth $50. When the business becomes more profitable and earns $200, so theoretically, the value of each share, if we're valuing it the same way that we did when I sold half of the business to Jay, so theoretically, each share now is worth half the business again. And now the business brings in $200 a year. So each share theoretically is worth $100 each. My share went from $50 to 100, and Jay's share went from $50 to 100. Now, theoretically, we don't know the future. Let's say I say with the instead of, now that the business is taking over all Nigeria, I have 2 food carts. I'm doing fantastically well. I want to purchase 10 carts now. But we know that a cart costs $50. So in order to purchase 10 carts, I need 500 $500. So how am I going to get $500? So now I'm going to get a loan from the bank or some other way. So now on my financial statements, I owe $500. I bring in $200, and $100 goes to the shareholder. So, but the company right now is going to owe $500 because I'm buying carts from my next door neighbor who makes carts, and I'm going to say, I'm taking a loan from the bank or from you. You're going to give me 10 carts, and I'm going to owe you $500. So the guy says, okay, you make $200 from the business every year so far, and you're going to owe me $50 every year for the next 10 years. So he has a claim on my revenue or my income every year of $50. And that's a debt that's outstanding for the next 10 years. So all these factors play into the value of the share of the company and how many shares exist for the company, the total value of the company. So this is part of what we're playing with when we talk about the share, the value of a share, and how many shares are available. Because if, let's say, I say to Jay, listen, I'm going to right now the shares are worth $50 each at the beginning when I sold him half of the business, but now I want to reduce the value of each share because I want to get more investors in. I want to sell part of my $50, but no one else in Nigeria has $50 to buy a share with. So I can't sell my share of $50 to someone else. He only has, let's say, $25. So what I'm going to do to Jay is I'm going to say, you have one share worth $50. I have one share of $50. Now I'm going to split it that I'm going to have two shares of 25 each. You're going to have two shares of 25 each. Now there are going to be 4 shares available of the company. And I'm going to sell one of my 2 shares of $25. And now I'm only going to own 25% or $25 out of the 100. And a third guy is going to own the other 25. And Jay is going to own the 50%, the 25 and 25. So, okay, this is all part of just really an introduction to the value of a share and the number of shares. And fine, it's not so valuable in terms of looking at a chart and buying and selling, but it's good information so that you understand how it works. So, okay, we'll continue in the booklet. We're on the third line. The stock market connects buyers and sellers, investors, orders to buy. I don't know if there was a symbol there, but didn't print out. Orders to buy or sell shares on stock exchanges like the New York Stock Exchange or NASDAQ, and trades happen when prices match. Okay, that I think is self-understood, self-explanatory. In simple terms, think of the stock market as a network of exchanges where people trade company shares. As more people want to stock, high demand, its price goes up. If more want to sell, high supply, the price goes down. Okay, and I think it works the same way with currencies, but there are market makers, and the market makers provide liquidity. And basically, if a bank like Goldman Sachs or J.P. Morgan or let's say Saxo Bank or whoever it is, they say we have a client that needs $500 million worth of a stock or a currency. So right now it's at the price of the stock is at $100 and they say they want it at $90. They don't want to spend 91. So the market maker is going to put his own money on the line, push it down to 90. He's going to get the order filled for his client at $90. Then he's going to buy it. And then he's going to ride it up to 110. Or maybe he'll short it at 100 and then buy it back at 90. So he'll get the client the shares that he needed and he'll make money himself. And in the meantime, you and I, who are buying at 100, we just lost our money because they just pushed it down to 90. Okay, unless we short it also. But then we better stop shorting and cover and buy it back at 90 because it's going to go back up starting at 90. Okay, that's the way the market gets pushed around. You have buy side liquidity and sell side liquidity. Stock. A stock or share is a unit of ownership in a company. Buying a stock means you own part of that company, as we explained before. Also, theoretically, if let's say the company goes out of business, my fruit stand, we just kept losing money. The only thing we have left is the cart or the carts. How much are the carts worth? So if all we have in the business is a few dollars left, so and let's say we still owe $500 to the cart maker. So the cart maker is going to say, okay, give me your carts, whatever you have left. Maybe they're worth less because they're used now, but you owe it to me. So he's going to take the carts instead of the money. And because there is no money. And then if there's a little bit left over, so then of the carts, so then the shareholders may share in the value of the carts. So that's how a share in the company is actually like ownership in the company. Stock market, a system of exchanges that lets people buy or sell stocks and matches buyers and sellers so that shares can change hands. Price changes, stock prices move based on supply and demand. If many buyers chase a stock, its price rises. If sellers dominate, its price falls. Making money, investing versus trading. People can make money in the stock market in 2 main ways: long-term investing and short-term trading. Long-term investing, you buy stocks and hold them for years. Over time, the company can grow and its stock price can rise, and some companies also pay dividends. Small profits share with shareholders. What that means is that a company will, let's say Jay and my business keeps making let's assume we did not buy the carts. So we make $100 a year, but we only need, let's say, $90. So another $10, what are we going to do there? We don't need to buy any more carts. We already have the entire business under control. There's nothing else we can invest in to make the company more profitable. We know everything available. There's nothing we can do. So what we do is with the $10 that we have no use for, we would just put it in the bank account. So instead, we return it to the shareholders. And returning it to the shareholders, let's say Jay and me, let's say we only have 2 shareholders. So each of us takes $5 in our pockets every whatever it is, every quarter, once a year, twice a year. So we take just for owning the shares, we get $5 extra in cash just because of the dividends. Long-term investors buy and hold, aiming for growth over years or decades. For example, you might buy shares in well-known companies and keep them for 10 plus years, benefiting from rising stock prices and reinvested dividends, compounding growth. This approach is generally less busy and focuses on the big picture. So-called, the market goes up and down. Okay. That's long-term investing, and I'll speak briefly after this about some of the differences between long-term investing versus short-term trading in the stock market. Short-term trading, you buy and sell stocks frequently, days, weeks, or months, or intraday, hoping to profit from short-term price moves. Traders watch charts or news to find swings in price. For example, a trader might buy a stock today and sell it next week if the price goes up. This can yield quick gains, but is riskier and requires constant attention. Traders often use tools and set strict buy or sell targets to limit risk. Because it involves rapid trades, it usually has higher transaction costs and demands active effort. It's actually interesting. I just looked at this past week. I opened up a new account, a stock account, at the beginning of June, the beginning of the month, and I saw how much the portfolio it went up over the past month. And I saw how much it went up. And then I saw my transaction costs, my commissions and fees. The fees were shockingly high. And I have a very low cost broker. I spent about 8% of my profits just in, I think that's how much it was. Assuming there was commission or whatever it was, compared to the profits themselves. But it was worth it because it was only, let's say, 8%, and I was much more profitable. In short, investors try to grow wealth steadily over time, often with dividends. Although that's more a long-term investor's mindset, because usually companies that, like Jay and my company, the one that we sell fruit from on the road. So if let's say we keep buying more and more carts to grow rapidly, so we're not going to want to split the dividends and extra cash that we have because we're reinvesting it into the business. So if you want a company that's growing rapidly, so usually they tend to use their cash and they usually have debt because they use the debt in order to potentially grow. But if they're an old company that's not investing their capital, their free cash, so they don't need the cash, they have no use for it, so they return it to the shareholders. So if you want a company like Coca-Cola, so then more likely, let's say they're making however many billions of dollars a year, but they're not investing nearly that amount every year. So they're going to return the extra cash to the shareholders in dividends. But if you're a trader and you're trying to take sometimes you could take a Coca-Cola company and trade that type of stock, or you could trade a faster mover, like a company like Tesla. And one will offer dividends and one will not. But it depends how fast you want the stock to move. So while traders try to profit from shorter swings in stock prices, both approaches carry risk. Stock values can fall as well as rise. Beginners often start with long-term investing before trying active trading. And the difference in a risk is that if, let's say, Coca-Cola only moves, let's say, 5 or 10% a year, but they return to you 3 to 4% in dividend, so you have to adjust your return with the value of the dividend, because now you add that onto the return that you got. You got your 8% return plus 3 or 4% of a dividend. So now you ended up with 11% of a return every year. So with a different company like Tesla, it might go up, it might go down. You're not getting a dividend. And if it stays steady at 0% for the whole year, you're not getting any money at all. If Coca-Cola stays at 0, at least you made your 3 or 4%. Okay. The brief history of stock trading, I'm not going to go through right now. I want to go through, I guess briefly through maybe some of the platforms, the brokers, only because I'm familiar with at least one of them, because I use them, and you can look into details another time. I happen to use the first broker, Interactive Brokers, IBKR, and they allow access to a lot of different markets. I'm able to trade any company basically throughout the entire world. I trade European stocks. I especially try to trade Israeli stocks. If you look at the markets, the charts of the countries out there, a few weeks ago, I looked at all the monthly charts of all the many different countries, basically the major European countries, some of the South American countries like Argentina and Brazil, Peru, and some African countries and Middle Eastern countries. And I looked at in Asian countries, China, Hong Kong, Japan. The chart that looked the hottest to me, like it's in the phase E of a Wyckoff schematic, which basically means it's ready for the run up, is the Israeli stock market. You're more than welcome to look it up. Look at, for comparison, I looked at the ETF EIS, and that is one of the Israeli ETFs. There are 4 of them, and it has many of the slower moving companies, not the tech companies. And you could also look at the Tel Aviv Stock Exchange index. It's called TA 125-125, and it's kind of like the S&P 500. Okay, so it's a collection of many of the major big companies. Okay, so okay, so right now I'm very, very, very bullish on the Israeli stock market. America looks good. The UAE, the United Arab Emirates, I thought looked very good. A lot of the European countries looked good, like Germany, Sweden, Switzerland, or I'm not sure about Sweden, Switzerland, I think Denmark, if I remember correctly. A lot of the European countries look very, very good. Poland, it's also like phase E of the Wyckoff schematic, which basically means it's ready to run up. So those are good markets to get into. For more details, I'll be happy to elaborate another time. But the European countries generally are good to get into right now because they have lacked the American stock market for many, many, many years, and they may lag again soon in the future. However, there are many opportunities there right now. In particular, I think it's the utility sector, and definitely the European banks, and they have double-digit annual growth and single-digit what's called a PE ratio, which basically means they're undervalued. So let's say the company brings in $100 a year, and they and the stock is worth, or the stock is $8. So that would give you a PE ratio, price to earnings. Your earnings is $100 and the price is $8. So it's 8%. So 8 divided by 100 is 8%. So the PE ratio is 8. So if you bring in $100 and the stock price is $14,000, you're going to say, how does that represent the value of the business or the income, the net income? But if it's only $8, you say the company is worth 100. So if you're only paying $8, so in a way that tells you that's a good value compared to, or a good stock price value compared to the income of the business. Okay. So now that is this brief introduction. Well, I don't know if I could call it brief anymore. But what I'm going to do now is I'm going to attach my notes that I wrote up. And this is what I'm going to go through now. Okay, I'm going to discuss why I trade stocks and how I trade them. So one of the benefits to stocks is that with stocks, with some brokers, I don't know if it's all brokers, and maybe, but with stocks, one of the things you can do is you can position size easily, meaning if the stock is $100, I'm able to buy, let's say, a portion of the share price. So instead of the share price being 100, I can buy a fraction of it. I could buy $1.17 of a share that's worth 100, and I'll own 1.17% of a share. I won't own a full share, but fine. My broker allows me to buy a fraction of a share. So for me, in my brokerage account, let's say I like to have each position to be $100. So it makes it very simple for me to have each position $100, because whether I need to buy 0.17% of one share or I'm buying 17 and a half shares, doesn't matter. I'm able to have every position start off the same way. So it makes it very clean to know if the value of the stock goes down by $10 in my account. If my portfolio started off at $100, I bought one stock, and my portfolio now, or the stock position, is worth $90 now. So I know I just lost 10%. So it makes it very, very, very simple. And that's how I trade my stocks. I put in the same position size for every stock that I buy. Okay. It's one of the benefits of stocks. With Forex and other things, you can get different positions, but you might only be able to get like 10,000 per lot or something where maybe it's a little different. Or let's say with CFDs, you could only get like one full lot or 0.5 lot or 0.1 or 0.01 or whatever it is. But for me, I like to do it down to the penny. I like to get $100, call it a day, and very clean, very simple. With options and futures, you're not able to get portions of the position. You have to get a full position. So we're focused on stocks today, so I'm not going to elaborate much on options and futures, but you're more than welcome to ask me about them. They're a little bit more complex the way they operate, but you have to buy a full position. So whether it's $17 or 17 cents or $1,700, if you can't afford the 1,700 and the $17, you just can't buy it. But you'll be able to buy the 17 cents position. That's how options and futures work, and there are different benefits to them, to each one. One of the differences is in the next line, the next note is that there's different tax treatment for these items. For regular stocks, in America, the way it works is that if you hold a position for over a year, so you get a lower tax, I would call it a penalty, but it's not a penalty, but you get a different tax rate. So let's say it's like 10%. So if you had a stock that's $100 and you held it for more than a year, and now you sold it, theoretically, let's say you made 10% on your money and you made $100 of profit. So you only have to pay $10 to the government, to the IRS, as it's called here. You pay $10 in taxes. If you own it for less than a full year, then you would owe like regular income tax. You would owe, let's say over here, it's let's say between like 12% to if you're making over like $500,000. So then it's like maybe 36% or whatever it is. So it's going to be taxed at your regular tax rate, whatever that is, whether it's 12%, whether it's 36%. That's if you hold the stock for less than a year. So having a long-term position saves you that 25% basically. So there's a big advantage to holding a stock for more than a year. However, if you think you can make up that difference in the taxes by trading actively, and you think you can make 100% a year, so you don't want to save the 25% in taxes because you're losing it by not being able to trade actively. So it's a risk though, because you don't know. The tax rate, you know, it's a guarantee. Your trading profits, you don't know. Also your dividends, okay, all this stuff that takes, you have to take that into consideration. In terms of futures, so with futures, no matter how long you hold it, whether you hold it for a few seconds or you hold it for years, the way the tax rate works in America, at least, is that it's a 60-40 split, that 60% of the profits. So let's say you made $100. So 60% of it, $60 is taxed as what's called long-term capital gains. So it's taxed at only 10% or whatever it is. And 40% of the gain, so $40, is taxed at 36%. So you owe on $60, you're going to owe 10%. So that's $6 of taxes. And then on the short term, you're going to owe 36% of that. So let's say that's about a third of the $40. So that's like $12, $13. So your 6 and 12 is $18. So you're going to owe $18 in taxes on your futures $100 profit. And as opposed to, so you're going to owe your, what we say, $18, as opposed to if you trade stocks and sell within the year or currencies, you're going to owe like regular income tax, and you're going to owe your, let's say, if you were making $500,000, you're going to owe your full tax rate of 36%. So with currencies, the way it works is if you own it for no matter how long, you're always going to pay your tax rate. And by the way, the reason I say $500,000 and 36% is not because I make $500,000. It's just for illustration purposes. 500,000 is super duper. That's like a lot of money here. So it's just for illustrative purposes. But with Forex trading, at least in America, you're always going to pay your full income tax rate, so 36%. And with stocks, it depends if you hold it long or short term, then the entire amount is going to be taxed by that percent, whether it's your 10% if you held it for a year, or 36% if you held it for 300 days out of the year, whatever it is, or a few seconds. And with futures, it's going to be split 60-40. Okay. Now, so that's a difference with the tax treatment. STGE is called short-term capital gains. That was my abbreviation, or long-term capital gains. And Forex has none of that. It's always called short-term capital gains. So if you want to look up these terms, then you could write that down. But in Nigeria, it could be that it doesn't even work that way. I have no idea how taxes works over there. Okay, so now to get into my system of how I do my stock selection and what I think is it could be applied to everything. First, I start off with, well, really my analysts and podcasts is where I start. I watch YouTube videos, I look at stock picks and recommendations, and I see what people recommend. And what I do is, let's say I look at all these different stocks. They say Apple, AMD, Microsoft, Amazon, Google. So now I have 6 or 7 stock pick options, and I look at all the charts. And right away, I say, ooh, is this a good chart? Okay, put it on a watch list. Do I like this chart? Yes, no, no, skip it. That's Google. Now go to Amazon. Do I like it? Yes, but not as much, but I do like it. Put it on the watch list. That one, the fourth one, Microsoft, I don't like it. Ignore it. Okay, now that I have 2 stocks on my watch list, first, what I do next is well, I'm kind of going out of order here, so I'm going to save that for later. But that's how I begin. But I have analysts that I follow, so they analyze fundamental data, whether it's interest rates and bond yields and economic reports and employment data and unemployment data and housing and reports and how many new homes were purchased and construction and all this stuff. And I look at their analysis. Is it true? Do I agree? Do I not agree? Look at the charts. If they say that based on these reports, so we think that electric companies are going to be doing well, and financial companies and AI. So now I start looking at companies in those categories, and I look at a bunch of stocks in those categories, and if I like them, if they look good, the whole category, so then I will I'm going to say, okay, this is a category to look at, and now I start comparing stocks within those categories. So if I look at AI, so I look at all these different AI companies. What's an AI company? So let's say Palantir, Tesla, Amazon, Google, they're very into AI now, believe it or not. Microsoft. So I look at all these companies within the AI space. Fine. And then I compare this is where it is, where I say the analysts and podcasts that I listen to, I watch, and I've shared that in the past. I'm happy to share it again with anyone who would like. I take all their picks, I put the charts up in TradingView, I go through tons of charts, and then I quickly say yes, yes, no, 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 yes, 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 put it on a watch list. Then the way I'm analyzing them is I'm not starting to draw trend lines. I'm not doing support and resistance. I'm not doing any drawings. I'm just looking at 50 stocks. Quick, 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 quick. What do I see on the chart? Is it Wyckoff? Is it not Wyckoff? Where is it up to? What phase is it? But not even technically. Just look at it very simply. Good, bad, buy, sell, ignore, not as good. If it's good enough, if it's in a good place, put it on the watch list. Now this comes with a background of having looked at many, many charts. So I'm not dismissing the value in putting drawings on your charts. However, it has to be put into context, because putting a drawing on your chart is telling you, it's helping you analyze what you're looking at. It's not telling you what to see in the chart. It's just helping you see what's already there. So you're trying to identify, is this stock or whatever it is there pressure, is there upward pressure for it to buy? Am I in a place of weakness or inefficiency? Am I in a fair value gap? Am I in an order block zone that broke a previous high? Did it break the high twice and then come back to that zone at the bottom? So because it's still above that low, it's still in an uptrend, because you're lowering your angle, because whatever. I mean, this I could explain in drawings, or if anyone wants me to elaborate in the future, I'm more than happy to, but you're still in an uptrend, but you're at a lower point in the trend. So there's more buying pressure. Because you wiped out the sellers, you got the liquidity grab, And now it's going to go back into the larger picture of being in an uptrend. So the concept is very simply, you want to look at a chart, yes, no, yes, no. Now, part of that, the system of being able to quickly identify yes, no, is that if you make a decision and you say, I think this is this is a stock to buy, and then you want to buy it. Now, what is the guarantee that you're making a good decision? If you go to your friend and you say, or you go to your bank account now and you say, I bought, or your portfolio, and you say, I bought this position, and then I went to pray to say, God, please help this position be profitable. I really don't know if it will be, if it won't be, but I really hope it will be because I need to make money. I need to make a living. I need to be able to buy food this week. Please help me. I took a gamble, but I really hope it's going to work. God is going to ask you, okay, why did you buy this? Why didn't you buy the other one? Why did you buy Apple? Why didn't you buy Microsoft? Microsoft was better. What are you going to be able to answer him? And I know I'm saying it in a funny way, but what are you going to be able to say? The reason I bought this one was because I was forced to buy this. Now, the answer is, the way I trade is that I want to be forced to buy Apple versus Amazon or Microsoft, even though I happen to think Microsoft and Amazon are better companies to buy right now. If you were to ask me, Apple is not a company to buy right now. However, I want the decision to be made by the system itself, not based on pure decision making and hoping. It's not a way to make a living. It's not a way to make money over the long term, and to not do that. And it makes me, for sure, it builds too much anxiety, because you're gonna go and you're gonna say, I hope this is gonna be the best winner. But you're gonna go to sleep at night and you're gonna say, but why didn't I buy the other one? The other one just went up 400% this year, and my company went down 4%. So why did I buy my company instead of the other one? You have to be able to give yourself an answer that makes sense and that you're confident with, and that you're comfortable with. So part of the system, I'm going a little bit out of order here, but the system itself, well, actually, yeah, I'm basically going in order. The system itself gives you the reason that you should buy one company versus the other. And that is because I compare the chart of relative performance of Apple versus Microsoft. What? So the system fixes itself, that I put into the chart in TradingView. Apple, AAPL is the symbol, / Microsoft, MSFT. If the chart is bullish, so it's just like Euro USD. You put in those two symbols with a /. If it's bullish, that means Euro, you're expecting it to be stronger. If it's bearish, you're expecting Euro to be weaker. So if interest rates go up in Europe or in the Eurozone, you expect the currency to be, people want to buy the currency. It becomes more valuable. If the interest rates are going down in Europe, in the Eurozone, and they're going up in the US, so you're going to want to buy the USD. So this is how it works. If we're in a risk-off environment, so people put their money into the USD and they take it out of risk-off or risk-on currencies, the riskier stuff. I don't know if that's the Aussie, that's a commodity-based currency, but okay. But the concept is, and the important thing is, that when you take a chart, you take a stock, you take Apple, compare it to another stock that you have on your watch list, and you only want the best one, assuming that you already looked at both charts and they're both good. So they're both on your watch list. But if you have to pick one because your portfolio only has $100 and your position size is $100, so you're deciding you only want to buy one. Although for me, I don't buy one position for the whole portfolio. Part of the reason that I have my system is that I like to have small positions. So if I had $100 portfolio, I would probably buy 100 stocks and buy $1 worth of each stock. But for our purposes, I'm saying you're buying one stock of $100. So that's what you're doing with the stock. When you look at a stock, you look at Apple. Before you buy it, look at competitors, look at other companies, look at Amazon, look at Samsung, look at Microsoft. Compare Apple to Amazon. Which is it, just like Euro USD? Is it bullish or bearish? If it's bullish, then I'm on Apple. Now compare it to Microsoft. Is it bullish or bearish? If it's bearish, now I want to buy Microsoft. Microsoft is a stronger stock. People are putting more money into it. But I go down to every single chart, every time frame until, and this is not just a comparison issue, but it's also a chart by itself. I look down to the last minute because why should I lose? Maybe like Jay said, and I'm gonna really take advantage of the stereotypes about Jews. The way I see it is every single penny that I put into the market is my penny. So if I can save myself a penny by getting a better position, and I think that looking at the chart in a certain way makes sense, and I'm looking at, let's say, weakness on the 1 minute chart, so I should wait for it to drop a little. Let me wait. Be patient. It's my money. It's not their money. I don't need to be in the position because in the meantime, I'm not selling my Microsoft until I buy the new one, the new, let's say, Euro USD or Apple or Amazon. Until I'm there, I still have my Microsoft and I think it's still good. So the concept is like that you want it to make sense to you. Every single thing that you do, you want it to make sense. You don't just want to throw your money because you need the money, you need to make a living, and it's very hard. So therefore, I'm going to gamble. I'm going to take a risk. We don't do that with the market. It doesn't work that way. So, but on the gamble, you might have much higher leverage, but if your chances of making money is much lower, even though you're going to make a lot more money when you play the lottery, it doesn't make sense because over time, statistically speaking, you're going to lose money. That's why the way I play stocks, I found that statistically speaking, I made money a lot more frequently and a lot more, I would say, predictably on the stocks compared to futures and everything else. And that's why I decided to continue and keep trading stocks. That's the concept. That's how I trade, and I find that it's very helpful for me. And I hope it will be helpful for anyone else and everyone else who would consider trading stocks. In terms of which brokers you can trade stocks with, that's another question. And whether they accept Nigerian clients or wherever else you might be from, that's another consideration. Some do, some don't. Just like with U.S. residents, some do, some don't. There are many that don't, some that do. And also we get less leverage on certain things like currencies, which is why I don't trade them directly. Okay, so now that is everything from my presentation. I hope it's helpful. I hope it's instructive. All the technical details in terms of actually analyzing charts and everything is a very important part of the system, and to be able to do it quickly. But I do find that having a lot of positions helps with the experience and just boom, 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 next, that you you give yourself the freedom to think, I don't need to buy this one because the next one looks good. And when you compare them, you force the decision that one looks better than the other. And therefore, you're confident that you're in the best position possible of those that you analyzed. My phone's going to die soon, and then I'm going to go. But if anyone has questions before I go for the next few seconds before it dies, please feel free. Otherwise, maybe we should reconvene, or you could write it to me or in the chat, and then you could either write notes or voice notes or call me directly or message me directly, whatever you'd like. But if it's something that everyone could benefit from, then by all means, include it in the chat. And when I say the chat, I mean the Telegram chat, because I think people will probably be more will have easier access to the Telegram chat to save any information there.